Hi, it's Aoife Devitt, and welcome to today's Markets Happy Hour podcast. It is Friday, November 7th, and this is actually the second podcast we are recording this week. We recorded earlier in the week with a special guest from KKR, Paula Campbell Roberts, and we will be delighted to release that podcast in the next few days. In the meantime, we have a little bit of the same content here, but obviously in the 2 days that have followed, there have been much in the way of market developments. So we're going to bring you up to date there, and let's move to the slides. I have called this week's podcast The Discovery Continues, as something we've been saying about Bitcoin for some time is that we are in the process of discovery when it comes to Bitcoin. We are still trying to figure out how this asset behaves within a portfolio context, whether it is pro-cyclical and in fact a risk asset, or whether it provides some kind of diversification, some kind of hedge. So we will see from the slides, it is proving to be much less of a diversifier, less of a hedge, and even an indicator as to risk appetite. So we'll ask whether we should be reading something into Bitcoin similarly to what you used to read into bond investor behavior and fixed income behavior. As usual, we'll cycle through 5 topics: inflation, interest rates, equity markets, geopolitics, and other asset classes. And today we're speaking again about the driver that electricity represents in inflation. We will look at this easing rate environment and the general lack of anxiety in the fixed income market, the sense of calm, the sense of low volatility, and even reflect that that is now in the actions of government bonds. Similarly, we're seeing a somewhat more subdued action in government bonds. We're going to speak about some investor nervousness when it comes to AI and how they are looking at other well-known short sellers and well-known kind of early indicators of a bubble in place and how that is representing. And again, we will revert to the Bitcoin charts to see how much Bitcoin can tell us of that. And as always, looking at portfolio implications for all of this, and have a little bit to say on currencies, as there has been a little bit of a surprise there in terms of how the dollar is behaving. Looking at inflation, we've spoken before about this new higher level of perhaps baseline inflation that is now closer to 3%. That has very important implications for where investors can gain return and what their real return looks like. It does raise the bar for returns, which is a little bit of a concern given where interest rates are going, and equally that there is some suggestion that equity markets are primed for a correction. So the real return is going to be under pressure and certainly under the microscope for investors. When we look at the drivers of inflation, as before, we know that services represent a large part of the inflation drive, but equally there's been much more focus recently on electricity and the share that power is taking of living costs as well as the inflation number. We can see that in the chart on the left, power is taking an increasing percentage of living costs. That has definitely ticked upwards since in the last 25 years. And similarly, in the last 25 years, electricity charges have been rising faster than overall inflation. It's important to remember that these charts show an average electricity price, and we should take into account that there have been reports that in the areas where data centers are located, a function of demand and supply, when demand is so much higher, there has been a dramatic spike in electricity prices. And again, it's worth a reminder that we are at this point moving into the colder winter season in the Northern Hemisphere. And of course, this will place increased demand for electricity with these shorter days. So something to watch on the inflation side. Again, this is regressive in that it definitely impacts the lower end consumer, the lower income consumer in a much more severe fashion, given that electricity and otherwise energy costs will represent more of the purse for that lower end consumer. So more pain at the lower end of the spectrum. Looking at the bond market, a recent commentary has suggested that the MOVE index, the fixed income volatility index, is quite a bit subdued. We're not showing much evidence of concern among bond investors today. There could be a suggestion that that has moved into the private credit market, where a little bit more of the action could be seen in terms of defaults and pain on the credit side. It is important to remember too, and we'll reflect on this later when we look at something that Julian Tett in the Financial Times said about bubbles, that the longer we go on the liquidity spectrum, the less impact we see in real time of a correction. There is not that daily mark to market. And in effect, there can be the bubble that is essentially fizzling out instead of disappearing in a bang. So if we move some of the strain in fixed income into the private credit market, that would then suggest that we are not prone to a big bang style correction, at least in fixed income. Equity markets could be another story. Just to comment too on movement in government yields, I think it's interesting to look at the UK, where there has been a pattern in the past of spiking of government bond yields when there is a crisis of confidence, or perhaps a lack of government confidence, certainly around fiscal and monetary policy. We know that there is a tough budget coming in the UK. This suggestion of higher taxes and lower spending, which is, of course, the medicine the economy needs, has already been reflected in a weaker pound. But what we can see here is that long gilt yields are certainly rising but not spiking. So perhaps the gilt buyer knows that this is the strong medicine that is likely, and they would actually rather see austerity take its place in a controlled fashion like this, even if it's not necessarily welcome, than a chaotic and dissonant fiscal versus monetary policy. So interesting to see that gilt yields, despite being higher, are still moving in an orderly way. Looking at the stock market, we are now having just passed election day in the US, one full year since the election of President Trump for his second term. And this interesting chart from Bloomberg shows just the total return across different indices in that time frame. And I think what's interesting to see is just how much certain sectors have really been outliers with respect to others. European defense stocks, perhaps not a natural beneficiary of a new Trump term, have been the surprise beneficiary, up 80% in total return terms in that full year. The Korean index we've talked about before, a bit of a sleeping giant there in terms of its performance. It's obviously tech is a big piece of that. Bitcoin has also benefited from the Trump government induced tailwinds behind that strategy. They're very pro crypto policy. Gold, we've spoken about at length, that's still up in excess of 50% in the year. Obviously, the tech stocks we've spoken about at length. It's interesting to see that other stock markets have not done badly either, between China, emerging markets, the developed markets, as well as the S&P. We can see that everybody is in very firmly in the black and very firmly in positive territory, and actually external markets outperforming, international markets outperforming the S&P. That's something we've known about for some time, and that probably reflects the dip that was seen around Liberation Day and the secession from the America First belief that was brief. 20-year treasuries about flat and oil prices down. So that has been, of course, the saving grace on the inflation number, oil prices being down. There's also been some fear around the perhaps economic activity that would that is on the horizon, but equally oil prices have been down. We know that inventories have been building in the US, and similarly, that the pro and the drill baby drill policy would have encouraged much of that. So an interesting scorecard here in terms of what assets have done well in the past year. Some surprises, some very much to be expected. And if we continue that into a US economy vibe check, quite a bit going on in this week. We've seen already that we've talked before about the large percentage of the S&P that is now represented by the top 10 stocks, whether it's 7 or 10. We know that they are increasingly taking an increased share of the S&P market value. And equally, a chart shown in this week's earlier podcast that CapEx by the four main players, Meta, Alphabet, Amazon, and Microsoft, truly out of the norm and quite extended when we go into 25, and particularly the last few months of 25. So stratospheric numbers when it comes to spending, how that will be financed, and we'll speak later about whether that's coming from debt in some cases. But other aspects of the vibe check, this shutdown now that will go into over 30 days, close to being the longest on record, is starting to bite. And where is that going to start to bite the ordinary consumer? Already we've heard about SNAP benefits being cancelled and then partially restored due to court order. But we've seen the three biggest US airlines about to scrap 600 flights due to the government shutdown and staff shortages. So that is something that will definitely be felt among the ordinary consumer and is likely to lead to some action. We also know that the outcome of the election in the US, November 4th, a sweep by Democratic candidates, which was expected, but the magnitude of the margin was perhaps sending a strong signal to the current administration that there is perhaps a focus on affordability, which was definitely one of the calling cards, at least of the New York mayor, as well as a focus on the pain from some of the Doge actions and the shutdown, and perhaps a lack of satisfaction with some of the policies. So whether that's around immigration, the big beautiful bill, and equally around healthcare costs. So clearly a bit of dissent being demonstrated by the population of those states at least. And equally with the fact that we are now moving on past the 30-day point and the shutdown, a sense there that action is coming, some form of corrective action will come. There will be a desire to save face on both sides, of course, but that there could be closer to a resolution. And then just another aspect of the vibe, we've seen Elon Musk celebrating his pay victory, managing to get this assurance of this participation, the compensation participation, which could be a 1 trillion pay package. Clearly, this will lock him in for a further 10 years, make him highly dependent on performance. This kind of performance-related pay, nothing new in US executive circles, but certainly raising the stakes for him in terms of the need to deliver. He already has posted on X that now is the time to be pulling rabbits out of the hat. And we hear about roadster cars and other new products in the pipeline. But I'd say there is a high expectation of innovation and delivery around Tesla, given where the valuations are standing today. Just to reflect on some additional data points that we used earlier in the week, tech spending is now starting to match the tech bubble of 99-2000. And we do know that in terms of, we've always recommended at Moneta having that exposure spread across the spectrum, not just in the Mag 7 stocks, but to spread it into the picks and shovels and the infrastructure and the data centers. They have been another strong winner of the year to date. And as the chart on the right shows, the blue line data centers have strongly outstripped the S&P as well as the Mag 7 in terms of performance. So investors already seeing this shift into the infrastructure side, and at least a catch-up factor there. The other thing to point out is also that on the small cap and mid cap side, many of these companies are supplying parts to that data center demand. So this will have a trickle down effect down the cap spectrum, and this should provide some boost across the cap spectrum, which would be another reason for assiduous diversification and rebalancing across the cap spectrum, given that many of these lower cap stocks are actually coming at a later stage. They're playing catch up at a later stage. So if there is some sell-off in the larger cap tech names, it's good to have exposure across the cap spectrum. Again, a chart that was shown earlier in the week in terms of where is this money coming from to essentially to fund the massive spending that is on the horizon. We do know that net debt levels are rising, at least in 3 of the companies here, Amazon, Microsoft, and Meta. And we also know that borrowing to fund data center spending has been explosive in September. There is strong demand for these bonds. We know that Google, in the UK at least, had an offering that was 4 times oversubscribed. So no shortage of supply when it comes to this debt. But we know these debts, we know the spreads are tight, but still there is still a reasonably high interest rate here relative to history, at least to recent history. So there will be an interest rate burden there. And the fact that it's no longer simply being funded out of cash on the balance sheet is a sign just how perhaps stretched some of these capital structures will become once they look to fund their capex spending. The other thing to say is, as they need to dip into borrowing and into other sources of capital to fund this spending, a natural thing to expect is to see cost cutting on when it comes to labor. And we've already seen that and spoken about that last week in terms of some of the cuts we're seeing in labor. So the big question is this labor cut necessarily relating immediately to productivity gain, or is this labor cut being made to preempt spending that will be needed elsewhere on capex, etc.? So there could be already AI replacement going on, although not actually in effect on the job yet. That AI replacement could be happening when it comes to the use of capital. Again, echoing some words earlier in the week, Michael Burry has been taking the headlines. He was last seen in The Big Short, being played by an actor. But we do know that what he's famous for is having called the subprime crisis early and taken a position around that crisis. He has on X quite publicly noted he sees a bubble. He did also suggest there was little he could do about it on the basis that he expected institutions to step in to avert a crisis. However, when it comes to individual stocks, he has taken significant short positions in some of these tech stocks, and that has now been noted by other market participants, and they have shown some pessimism regarding that. So definitely something to watch in terms of the short sellers. They could, of course, be early. They have the risk tolerance to be early, but it's worth listening to what they have to say. And I've always said that the main risks in equity markets relate to leverage and concentration, as well as liquidity mismatch. And there was an excellent article by Julian Tett in the Financial Times, who is calling out the 3 L's when it comes to a bubble. Leverage, of course, we know that is absolutely the thing that can amplify risk and amplify losses and force liquidation at the wrong time. Liquidity, i.e., mismatch of liquidity, usually that's what also causes forced selling of other assets that can be sold if there are illiquid assets that cannot be sold. Mismatch of assets and liabilities have long been a source of pain in financial markets. We see less of that today, given there have been lessons learned, but still private credit with its illiquidity could be a source of some of the pain, and certainly some of these newly created interval funds, quarterly liquidity funds, could be a source of some of that pain. And then simple lunacy, getting carried away, the sense of drinking the Kool-Aid around certain stocks, the sense of hockey stick trajectories being the norm, and perhaps an exuberance, an irrational exuberance around certain sectors. We definitely have seen strong signs of that when it comes to AI, and it's difficult sometimes to separate the signal from the noise. So this is I think a warning sign to be aware of these three factors and how they gather. Looking to Bitcoin, this has been a very interesting mover in the past week. It is now down from its high, which was around 126,000. It's now around $100,000 Bitcoin. It has been a fall from a record high, which has been a reminder of its volatile nature. In previous podcasts, we've spoken about the correlation between Bitcoin and discussions of US-China trade, and really just how much of a risk on asset it can be. This is suggesting that Bitcoin is actually a bit more like a canary in the coal mine, in that it can actually be an early warning indicator of an equity correction. And this chart on the left has shown just how Bitcoin in the gray line, the pale gray line, has performed relative to the high volatility stocks index, and very much tracing almost like for like, but equally when there has been a dip in Bitcoin, it has been followed quite closely by a dip in the high volatility stocks. And we know that the large cap tech stocks are all the high volatility stocks. So if Bitcoin is sending us a signal, this is perhaps a signal we should pay attention to. And I'd say if we look at what are the processes of discovery around Bitcoin and why many asset allocators, such as Moneta, have been pausing in terms of using it in portfolios and instead have been on the education journey in terms of how this asset is likely to behave. Is it a currency diversifier? Is it a hedge? Or is it just a very high octane way to play risk appetite? What we can see here is in terms of its correlations, the highest correlation that Bitcoin has shown over 5 years, and bearing in mind that that history is not perfect. It was certainly had a different profile in its early years and has had a very different kind of, let's say, ownership profile as well over those 5 years. But still, if we look at the numbers we have, the highest correlation is to the NASDAQ, so as to the higher octane stocks, certainly with a tech orientation. That's still only 0.54. So it's not a necessarily particularly high correlation. It's also high correlation to SPACs. Again, these creatures of exuberance that emerge from the tech cycle. High yield bonds, some correlation, has very little correlation to gold, zero, has negative correlation to cash, some modest correlation to commodities and to emerging markets. But the notable correlations are to the higher octane tech indices and zero correlation to gold. So despite the fact that gold and Bitcoin have moved in sync over the past immediate period, certainly the year to date until this current correction, we can see that it hasn't necessarily behaved like gold. So really to equate the two has probably been just purely coincidence that they've looked the same as opposed to any overlapping characteristics. And in the meantime, gold has continued to show its stripes as a tested diversifier. We can see that as the uncertainty index has risen, so too has gold. It's still up over 50% year to date. Whether that's sending us other signals in terms of uncertainty, or whether part of this has simply been the technical factor of other central banks buying gold, we don't know for sure, but it is certainly behaving as we would expect it to behave, and that would suggest that it is a more reliable hedge than Bitcoin, because we still are at the discovery phase for that. Finally, on Forex volatility, again, a little bit of a surprise in terms of little having changed on the geopolitical front. It has been a bit of a slow news week for geopolitical news, but the US dollar has been looking stronger. Has not been much. We know that tariffs remain at the Supreme Court. That decision there is pending. That looks like, if questioning is leading us to any conclusion, that there's certainly a skepticism regarding the legality of these tariffs. And the scenario that could evolve from that is that they are removed or deemed illegal, certainly until there is a workaround to put them in place by some other means. So that would generally be positive for both geopolitics and equity markets. But what we can see is that the dollar has been strong, questioning as to whether that's due to inherent strengths of the dollar or due to weakness of other currencies. And I've already mentioned that due to some concern around the pending budget in the UK, the UK pound has been near a 2-year low versus the dollar. So the dollar is strong, but is it because of its own intrinsic characteristics, or simply because other currencies are weak for their own intrinsic reasons? So that will, of course, affect portfolio behavior in terms of, for the non-US investor, a strong dollar is generally a good thing in that they do not have the erosion of the value of their generally unhedged external assets, most of which are dollar denominated. When it comes to the US investor investing abroad, a strong dollar is the behavior we saw for many months and years, and that can offset some of the benefit of investing internationally, but not massive movements, and still quite low relative to its high that we saw at the end of last year. So that is our podcast for this week. I will look forward to seeing some of you in Dublin next week. We're going to have a live event on Friday, and more details will be coming out about that. And thank you, everyone. See you soon.